Kitco News special coverage of the Pacific Bitcoin Festival is brought to you by Swan Bitcoin.
Hello, I'm Michelle Makori, and we are at the Pacific Bitcoin Festival, where over 1,300 Bitcoiners have gathered, including Lyn Alden, renowned macro strategist, founder of Lyn Alden Strategy, a board director at Swan Bitcoin, and the author of the recently published book, Broken Money: Why Our Financial System is Failing Us and How We Can Make It Better. And of course, a fan favorite here on Kitco. Great to have you back, Lyn.
Happy to be back. Always happy to be on Kitco.
Okay, well, we love having you, and we've got a lot to discuss, including your book, Broken Money. We've got to focus on broken government first, and then of course we also want to get your forecasts for Bitcoin price and how gold fits into all of this picture. But let's start off where we left off, and last time we chatted was at the Bitcoin Miami conference, and at the time the debt ceiling was a big issue. It subsequently was resolved. Of course, we're now potentially facing another issue with a looming government shutdown come mid-November, now that House Speaker Kevin McCarthy has been ousted and the government's only been funded for 45 days. So a lot to see how that develops. But before we get into that, last time we chatted, you raised the issue that once the debt ceiling is resolved, what could happen is there could be a liquidity crunch as the Treasury refills its TGA, the Treasury General Account. And you said that it could cause breakage and a liquidity crisis as the Treasury sells securities to refill its coffers. So where are we on that concern?
So when we talked about that, we outlined also a couple of ways that they can resolve that. Basically, things that if they don't do, we're going to have a problem. In that environment, what the Treasury did was they chose the path of saving liquidity the most. So they issued an extra amount of T-bills rather than T-bonds in order to refill that TGA. So they got past that liquidity crunch. A lot of that liquidity was able to come out of reverse repos. Because one way to think about this is that right now there's more demand for T-bills than there are T-bills. And it's not always the case. Back in 2019, when we had the repo spike, there were too many T-bills relative to liquidity. In this environment, while there's obviously demand issues and supply issues on the T-bond side, the longer duration, there's plenty of demand for T-bills. Mm-hmm. And one thing that the Fed does is that there's too much demand for T-bills. It risks pushing T-bill yields below their target rate. And so they have to have a release valve that money can go to that doesn't push those T-bills down. And so reverse repos are basically their facility to make it so that excess money can go into money market-like, T-bill-like access. And as that liquidity crunch approached, they refilled it by issuing extra T-bills, and that allowed money to come out of the reverse repo and back into the markets. Now, what we're seeing in recent months is that they've kind of gone back to their normal cadence of longer duration bond issuance in addition to their T-bill issuance. And these long duration bonds, the buying power for them cannot come out of reverse repos. Okay. And so we got past that initial summer liquidity concern. Basically, the Treasury, they actually issued by issuing T-bills, they issued money on the most expensive part of the curve, right? So if you're the Treasury, you have to manage a couple things. Ideally, you want to reduce your interest expense as much as possible. And then in that environment, the longer duration was lower yields, inverted yield curve. But they chose to issue extra on the T-bill side because that was better for liquidity. So higher expense, but better liquidity management.
So in terms of a potential crisis trigger, that has been successfully resolved for now, or are you still watching that as something that could cause breakage? So
the TGA refill was successfully resolved. Now we're kind of in the second phase of whether or not the longer duration bond supply is going to overwhelm market conditions. We've kind of seen that in recent months. I wouldn't really describe it as disorderly yet, but it's certainly among the things in the market that you can keep your eye on. These bond yields, the MOVE index, so bond volatility, and overall, just kind of bond liquidity conditions, I think are a key thing to watch going forward because this is one of the more troublesome spots in the market.
Okay, but not as concerning as it was before. Still troublesome, but no, like the flashing panic of that element has kind of been somewhat dampened now.
Yeah, it's been shifted to the longer end.
Okay, so debt ceiling crisis resolved. Now we have the idea of a government shutdown. The government was supposed to shut down. They cut a last-minute deal. That last-minute deal brokered by former House Speaker Kevin McCarthy, which cost him the job because he has subsequently been ousted by Florida Congressman Matt Gaetz, leading a vote against him. The government was only funded for 45 days with that stopgap measure, meaning come November 17th, the government runs out of money. And with this political chaos in Washington, not having a House Speaker, obviously bitter bipartisan divide between Democrats and Republicans, how likely is it, do you think, that we will get a shutdown come November 17th?
So I'm not a political strategist, so I usually don't go into that many details. Generally, the government shutdowns are not as impactful for financial markets as things like debt ceiling issues, because it's kind of a different type of environment. During a government shutdown, like one of these more other types, they can still issue debt. Basically, there's still treasury functioning during that time. It's that they classify them as non-essential workers, basically meaning that workers that can stop working for a period of time and things don't fall apart right away. Those go on basically a paid vacation for a period of time. And around the margins, it can impact the economy to varying degrees. Those workers, for example, they might just be at home more. They might not be out and going to restaurants as often, like work lunches, things like that. People might not be traveling for national parks because they'll be shut down. So around the margins, it has some economic impacts. And the longer it goes, obviously, the more economic impacts it can have. But overall, that's more of a political issue for the most part than a financial issue. Whereas the debt ceiling issue does impact financial markets more because leading up to a debt ceiling issue, they have to draw down their cash balance, which, as we discussed previously, is actually pretty good for markets when that's happening. And then after the debt ceiling issue, they have to refill those cash balances, which, depending on how they handle it, could be negative for liquidity. So this overall government shutdown is something, it's certainly material from a political aspect.
Yeah.
I view it as not the highest priority thing I'm watching from a financial perspective.
All right, what about the impact that this could have on faith in the US government, faith in the dollar in terms of credit ratings? I mean, we saw that after the debt ceiling, Fitch downgraded the US credit rating to AA+, lost its AAA rating, citing government debt and the lack of ability of Congress to control spending. We're seeing that play out. And Moody's is warning that a shutdown would harm its AAA rating for the US. So do you see a government shutdown, whilst not having broader economic impacts, potentially leading to a credit downgrade? And would that have any impact?
So it's less impactful than the debt ceiling issue because that actually does risk some degree of technical default if it were to go undressed. This is less about a default and more about just overall perceptions of political stability. Mm-hmm. If we imagine ourselves investing in an emerging market, for example, probably one of the most important variables we're going to consider is the stability of their government and their institutions and things like that. And it's less so for developed markets because they're generally presumed to be relatively stable. But when you start to see signs of instability like this, that's when you do get questions around could the right or left tails of more extreme things emerge in, say, a 3-year, 5-year time frame. The probability of those things start to go up when you start to see less stability like this. And so it could impact credit ratings around the margins. Generally, the U.S. Treasury market, it's not like bond funds will change their decision to buy treasuries based on what Moody's says the credit rating is. It's more about supply and demand. But I think the underlying things that are addressing it, the overall fiscal deficits that are just completely unaddressed, overall kind of confidence that Congress and the president will be able to get together and realistically address those deficits, that I think is the most impactful thing for the overall dollar, the treasury going forward, is basically the perception of these deficits and then the perception of the probability that they ever get these deficits under control.
Right. But if there is a Moody's downgrade, and I get that it doesn't necessarily hurt demand, and in fact, the dollar's been quite resilient through all of this, does it start to eat away at positive US dollar sentiment, especially in the context of a de-dollarization trend that we've been seeing?
I think so. I think those perceptions themselves are usually overstated. We don't usually see people in other countries say, well, because this is happening, I'm going to buy another currency instead. Mm-hmm. Instead, I think it's the more quantitative metrics. Things like, how large are the deficits? Are there any plans to get them under control? And so to the extent that these affect those plans to get them under control, that's meaningful. But really the deficits themselves, the years and the decades that led up to this, not just the current environment, but the overall entitlement system we have, the military spending we have, the tax base we have, there's been kind of all these incremental decisions that have resulted in these very large structural deficits with no clear path to fix them in the years or decades ahead. And that, I think, over time chips away at U.S. perceptions.
Right. So not any kind of immediate impact. What about what we can expect from the stock market, from U.S. equity markets? Do you anticipate a reaction there to a government shutdown and a potential further downgrade by Moody's on top of the Fitch's one?
Around the margins, it's possible. Generally, it's not a huge market variable historically for these kind of government shutdowns. But I do think that what we previously talked about, these kind of rapidly rising bond yields, that, in my opinion, is a far more like a more important thing to focus on in this environment is, are those bond yields going to keep going up? Are they going to stabilize? Because that has a much higher discount rate. Now, when we look around at the rest of the market, when we look at, say, large cap equities with 30 price to earnings ratios, when you can earn 5% on longer duration bonds, for example, that can eventually affect the pricing of those equities. So it also can cause all sorts of liquidity problems, both globally and domestic. So I think that what's happening in the bond market now is more impactful than what's happening in the government shutdown news, at least for financial markets. Obviously, if you're in the political sphere, that other side is going to be very important. But for us in the financial markets, I think the what's happening in bond markets is more important.
So you're not terribly concerned about the government shutdown in terms of a broader impact on the economy. You said that is not your highest priority. What is? Is it what you just mentioned, the bond market?
I would say, yeah, the combination of looking at the dollar index, the yields, and the price of oil. Because when you have a lot of these things rising together, that puts a lot of pressure on developing countries around the world, right? They have dollar-denominated debt, and that debt is hardening relative to their cash flows. And then if they're a current account deficit type of nation, if they have to import energy, and you have a strong dollar and you have strong oil priced in dollars, imagine what it is priced in their own currencies that are weakening versus the dollar while oil's strong. So this puts a lot of pressure around the world. And ironically, there's an inverse relationship between the dollar and treasury yields. You would think that if the dollar's rising, it means a lot of people are buying treasuries. But it actually is not the case. When yields are going up, when the dollar's going up, generally a lot of the foreign buyers are pulling back their purchases of treasuries because they're more in currency defense mode. Mm-hmm. When the dollar's weaker, they often go out and buy treasuries. They accumulate reserves. They basically, weaken their currency, gather more reserves. And when the dollar goes up sharply, like it has recently, they go on a buyer's strike. They might even sell some treasuries in order to defend their currencies. And so in this type of environment, strong dollar, higher yields, and pretty high oil prices, it's challenging to see where all this supply of treasuries is going to get bought from. And I think that's a key risk to keep watching. Okay,
so there may be surplus treasuries and not enough demand for them on the global stage, is what you're saying?
Yeah, and that's what we've seen in recent months. Basically, there's over $1.6 trillion deficits right now, annualized. And then the Fed is reducing treasuries from their balance sheet. They're letting them mature without reinvestment. So it's equivalent to selling them. You have domestic banks are no longer buying treasuries. They used to be one of the biggest buyers. They've obviously had stress in recent months, and so they're not buying treasuries. And the foreign sector, because the dollar is strong, they're not buying treasuries on net. And so that leaves pretty much domestic non-bank institutions have to buy all of this treasury issuance. So that means insurance companies, pensions, asset managers, hedge funds, and actual households. They're the only one, that's kind of the only segment that is able to absorb this issuance unless we see something like either the dollar decline significantly, that could bring in more foreign buyers again, or if we see the price of oil decline significantly. Basically, unless some of these things fall, there's a heightened risk of liquidity issues, market functioning issues, equity markets not doing as well over, say, the next 6 months as they did earlier this year. These are more risks on the table with the bond market doing what it's doing lately.
Okay. What would this government shutdown mean for Bitcoin in the sense that it further highlights an ineffective government? Do you see that impacting Bitcoin in any way?
I think the narratives kind of write themselves. I mean, it'll be good for the Bitcoin memes and that kind of ecosystem. I think on any sort of again, when you look at most asset prices during government shutdowns versus not government shutdowns, it's usually not like this immediate impactful thing. It's not like the government shuts down and markets go haywire, because it's more of like this behind the scenes slow motion thing that's happening. All the essential stuff's still happening. The Treasury's still issuing debt. Things just, kind of the more time sensitive stuff is still happening. The military is still at their posts. Mm-hmm. Those things are still happening. And so it's more of like that slow perception. And it really kind of feeds into the idea, Bitcoin is this decentralized network. There's nobody unilaterally in control of it. It's open source, so people can build on top of it. They can shape parts of the network, but there's no kind of central authority. Whereas, right now the biggest money in the world is the dollar, and that's essentially the Federal Reserve's ledger. So it's a centralized, nation-state ledger, partially controlled by the Fed, partially controlled by the government. And when you see the dysfunction in Washington, it does start to chip away at the perception over the long term. The more this happens, the higher magnitude this happens, it kind of contrasts. These are the people that we're relying on to manage what we use as what we earn our wages in, what we have our savings in. These are the people that are running the centralized system.
Right, and yes, we've had government shutdowns before, but we haven't had a House Speaker ousted in the manner that we just saw Kevin McCarthy ousted. And this comes in the context of other political dysfunction. I mean, many would argue that President Trump, who's facing a number of indictments, is seeing the system being weaponized against him. Without necessarily getting into the political side of things, you have a former president, a potential frontrunner for the next round, being targeted by the system, and the terms banana republic tend to come up when you see that. You see the lack of cohesive management in Congress as well. So from an ideological point of view, does it start to seep in terms of, as you just said, people are looking and saying, these are the people running the country, this is what's really happening. Does it change perceptions and therefore I want my money in Bitcoin as opposed to dollars, or not yet?
So I think the speaker point is interesting because that was a rather unprecedented moment in American political history, the way he was ousted and the shortness of his term. And when we go back
as is all these indictments against a former president.
Yeah, well, we had the Nixon era too, and they went in a different direction for that. But I think one way, when we go back to the question of do government shutdowns matter, I think it's one of those things where 9 times out of 10 they're not going to matter, and historically they've not mattered. But it's one of those things you don't know ahead of time which time it actually might matter. There may be something so dysfunctional happens that maybe it does matter this time, right? That's one of those kind of unknowable questions.
Yeah.
And when you have bond yields this high, when you have equity markets still kind of in a trouble zone, I do think this is an overall time where you don't want to be overextended in terms of risk overall, because we can kind of go over the statistics or the reasons why a government shutdown is generally not that impactful, but we can't necessarily predict kind of these tail outcomes of something where it suddenly could matter.
Right.
And so Bitcoin is one of the advantages of Bitcoin is that it's a global asset. It's not controlled by anyone. It's self-custodial. It can't be diluted. And so anytime you have dysfunction in some of these major markets, these major currencies, it does over time feed into the Bitcoin narrative. But I think what really kind of contributes to Bitcoin's next bull run is not something like this necessarily. It's one of a couple things. It could be the spot ETF approval. If we get one of those, that's a new demand source. But the metric that Bitcoin is historically most correlated with is global liquidity. So if you, for example, were to have the central bank intervene on these bond market situations, kind of like how they had to intervene back in March on the banking system, whenever you get that kind of liquidity intervention, that's when Bitcoin's likely to do very well. It's very responsive to that historically, and I think it probably would be again. So that's the kind of thing more I'm looking forward to what's going to propel Bitcoin's next bull run. But all these kind of narratives around the margin, I do think feed into the longer term narrative of Bitcoin.
Before we get into a more specific Bitcoin price forecast from you, I mean, it is interesting because you never know what the event is until hindsight that triggers a whole range of events and that things can snowball. It was one of the points made when they were voting to oust McCarthy. And whether you support him or not, what could happen now is stopping funding to the war in Ukraine. Whether you support funding the war in Ukraine or not is another matter, but that in itself could lead to some kind of escalation in the war with Russia, which may somehow embolden China. So you never really know what that moment was until you're further along in history and kind of go back and go, aha, that's when it all started to fall apart. Should this potentially snowball into that? Is that having any impact on the price of gold? I mean, it hasn't so far. So gold is not responding to the uncertainty that this could cause either.
Yeah, so far in this environment, Bitcoin's kind of held up surprisingly well, and gold's been a little bit surprisingly weak given the geopolitical things happening. And sometimes there are major events that people know right away as major events, and there's other ones that you realize in hindsight are major events. And so I would describe, for example, back in 2022, the freezing of Russian reserves after their invasion. That's notable from a monetary standpoint because now there are more countries that are not on great terms with the U.S. That maybe think twice about how much allocation they want to have. Now, in Russia's case, they were already de-dollarizing. They were already kind of prepared for that. But I think they were surprised, as far as I can tell, from the Europeans going along with it. So these other countries are maybe thinking, okay, how much do we really want in U.S. or European assets versus how much we want to have in our own self-custodied gold, or how much do we want to have in a diverse array of holdings. And so that's one of those things where if you go on the average person in the street and say, what do you think of the Russian reserve seizure? They probably wouldn't know what you're talking about. But I think that's one of those things in history books is relevant for changing reserve practices globally.
Yeah, weaponizing of the dollar with that move definitely has ramifications that we're continuing to see. And we'll talk about that. But let's go back to this Bitcoin price forecast because you recently tweeted, I like the orange coin for the next few years at current price levels. No firm opinion on in the next few months. And this was in response to a tweet by Samson Mao, who said in a single day, the US added more than half of Bitcoin's entire market cap in debt. That's something like 10 million Bitcoin. And yet there are still people that are unsure if 27K is a good price to buy. So when you say you like Bitcoin at current price levels for the next few years, you're saying you like it at 27,000 for the next few years? What?
No, I'm saying that at 27,000, I think it's an attractive price when looking back several years from now.
You mean to buy it?
To buy it,
okay,
yes.
That's not your price forecast then.
No.
Okay.
No, I think this is a good accumulation zone.
Okay.
And it's basically saying that I'm bullish with a multi-year time frame, but a multi-month time frame is mostly going to be governed most likely by liquidity or things like spot ETF approvals or denials. There's all these kind of things that just can throw curveballs and change. If we do get kind of a bond yield spike and a dollar spike and a liquidity problem, Bitcoin could go down a few $1,000s again. Who knows? So I don't really trade it on a week by week or month by month basis, but I do think looking back 2 years from now or so, I do think that 27,000 is an attractive entry price. And then you just have to manage your volatility around that. So if you're an 80-year-old retiree, you have to manage that volatility that Bitcoin has compared to if you're a younger investor. And then, of course, you also have to manage how much have you looked into Bitcoin, how much have you studied Bitcoin versus are you just looking at a price chart? Because I would argue that the more you understand it, the more you kind of naturally want to have exposure to it, but maybe not for everyone.
Right. Okay. So if you're saying that getting in at 27,000 in 2 years' time is going to look like a good idea, begs the question, where do you see Bitcoin price in 2 years' time? For the number go up people that always like to hear a price forecast.
So conservatively, I expect it to probably be double by let's say late 2025. So, a little over 2 years from now.
So that still wouldn't hit its all-time high.
Yeah, but I think that's the conservative level.
Okay.
I think the range of outcomes, like 6 figures, would not surprise me at all. Generally, what we see is that if you look at measures of global liquidities, and we can define that as global broad money supply in dollar-denominated terms, right? So that comes down to how strong or weak the dollar is relative to other major currencies, and how quickly are their broad money supplies expanding. Bitcoin is highly correlated with that metric. So generally speaking, when money supplies are going up very quickly and or the dollar is weakening, generally Bitcoin's in one of its major bull runs. That's historically what's been the case. Whereas when the dollar is strengthening, when global liquidity is tighter, when we have quantitative tightening, when we have these kind of attempts to rein in this inflation, that's when Bitcoin has a bear market and then a big consolidation market. And so again, the next 6 months, liquidity, pretty hard to predict. Right. But I would very much expect that within the next 2 years, we're probably going to have another positive liquidity cycle. I would say that it's very hard for them to manage things so tightly for another 2 years. And so if we do get that another positive liquidity cycle, I would expect it to be very favorable for Bitcoin. But there's an inelastic supply. There's a potential spot ETF. There's how much liquidity are we going to get? There could be trend changes in certain countries, for example. Maybe a lot of people in India, for example, maybe Bitcoin starts catching on there. Maybe it doesn't, right? So there's these outside variables that could really change Bitcoin being at, say, 50,000 or 200,000. And so I would expect that in the next cycle, the next, say, 2-3 years, I would very much expect to reach new all-time highs. 2 years specifically, conservatively, I would say I'd be surprised if we're not significantly north of here. That's why I said 50,000 as what I would consider kind of a conservative target, but it could comfortably be in the six figures. And I think that rather than thinking with specific price levels, the way that I approach this is this network and is this asset more attractive than other things I can buy on a multi-year time frame? And my assessment for Bitcoin is that it is. It's still, on a risk-adjusted basis, one of the things I definitely want to have exposure to, not to be all in on, but to continue to have significant exposure on.
While maintaining exposure to gold as well?
Yes, I'm also long gold, I'm long T-bills, I'm long energy producers, energy transporters, and then a variety of other stocks too, kind of growth at a reasonable price, equities, certain international equities, real estate exposure, all that's been tricky lately, of course, but I personally maintain a diverse book of assets. The one that I think is the most dynamic, the most interesting over the next multi-year time frame would be Bitcoin.
Yeah.
And in addition to owning the asset, I also do some venture capital work in the space. So I work with gov't Capital, and part of why I'm bullish is we see the pipeline of startups out there or companies expanding and new ideas. And so we see the kind of the things that are on the horizon, not just for this cycle, but for the next cycle in the years ahead.
Kitco News special coverage of the Pacific Bitcoin Festival is brought to you by Swan Bitcoin.